Stablecoins have become one of the main terms that newcomers to DeFi come across. And in this video, I want to introduce different types of stablecoins that exist because there's hundreds of stablecoins. How is somebody supposed to know what's the difference? Is it just the name? And I decided to put them into three categories that we're going to cover. We're also going to cover what are the mechanisms that help them work, so the pegging mechanism and the depegging risks, and we'll also cover yield-bearing stablecoins quickly. So to start off with, I decided to separate them into three types: fiat-based, crypto-backed, and synthetic stablecoins. So the easiest concept to understand are the fiat-backed stablecoins. That's USDC from Circle or USDT from Tether. And the way that these stablecoins work is there's a company, it has fiat money somewhere in a bank, stored somewhere. It can also have treasury bills, it can have other real world assets. But the point is that the stablecoin, which promises to be worth $1, actually has a corresponding asset in the real world that can represent its $1 value. It can be redeemed for that $1 at any time. Now, crypto-backed stablecoins work a bit differently. So they have a crypto asset that's backing them instead of a real world asset. And one of the examples is DAI and BOLD. Now, DAI is the MakerDAO stablecoin. BOLD is the Liquidity V2 stablecoin. How do they work? So a user would have to come to the protocol like MakerDAO or Liquidity V2. They would supply their crypto token, for example, ETH or Bitcoin. In the case of Liquidity, it's just ETH and liquid staking versions of ETH. And they would be able to then mint or create this stablecoin, which represents a certain percentage of that crypto's value. So you supply one ETH to a protocol, it can give you, let's say, 80% of that ETH's value in dollar value in this stablecoin. Now, what's the safety mechanism there for the protocol? Well, it's liquidations. That if the price of your collateral falls too close to the amount that you borrowed, the protocol is going to actually sell off your collateral and it's going to repay the debt. Super quick intro on that. Now, DAI works based off of ETH and Bitcoin collateral. BOLD is just ETH and LSTs. Now, synthetic stablecoins like USDe works with a underlying strategy. USDe is still backed by crypto, but the way that Ethena works is that, for example, if ETH is backing USDe, then that same amount of ETH is on a spot market and on a perp short market. Now, what does that mean? It's a delta neutral strategy. You buy something and its price can go up, it can fall. Well, you buy it expecting its price to go up. And then to stay safe, you open a perpetual short position, meaning you're earning if the price goes down. So if its price goes up and the short price goes down, you're going to be at a net zero. Since one asset is going up, the other asset is going down in price, you're at a zero. And that's how USDe maintains its $1 price. Now, we move on to the peg mechanisms. And peg is essentially the mechanism of keeping the stablecoin at a $1 price. So you can imagine that it's not that just somebody says, hey, this is worth $1. There has to be a mechanism that's going to keep it that value, not at all times, because we'll see a bit later, market pressure can make a stablecoin actually trade under $1 or even above $1. But these are some of the mechanisms that's actually going to help maintain that price at $1. So first of all is redemption. So for example, with USDC, you can redeem one USDC and it's not you. It's usually not retail. It's mostly large firms and companies that can actually redeem USDC, a large amount of it, for the fiat that's actually backing it. So you can think of it this way: if USDC ever trades below $1, then that's an opportunity for these companies to step in, buy a lot of USDC so they can redeem it for $1 worth of the fiat backing. And since a lot of USDC is going to be bought, that's going to push the market price back up to $1. In the case of crypto-backed stablecoins, with BOLD, the redemption mechanism works like this. You have ETH backing this BOLD. At any time, you can come to Liquidity V2 and redeem one BOLD for $1 worth of ETH at all times. So if BOLD ever trades below $1, let's say for 98 cents, you can buy it for 98 cents, but redeem it for $1 worth of ETH. So it's an opportunity to earn, or that's also called arbitraging. And it's these arbitrage opportunities that are going to lead a lot of people to buy BOLD, and since it's going to be bought, its price is going to actually be pushed up to $1. So again, it's a safety net from it ever crashing below $1. There's always going to be market interest in buying it so that it can be redeemed. Now, DAI has a bit of a different mechanism. It's not exactly redeemed for the underlying collateral. The way that it actually works is that when somebody generates new DAI, that means they're putting more DAI out there in the open. So that means that if DAI's price ever, due to a huge amount of it being available and market pressure, if it falls under $1, MakerDAO would want to actually lower the amount of circulating DAI. So what's going to happen is it's actually going to become more expensive to borrow DAI. That's going to lead a lot of people to repay their debt, and that's going to lower the circulating supply of DAI. Since it's going to lower the circulating supply, the price can bump back up to $1. Likewise, if it's trading above $1, a lot of people are going to come in, they're going to mint that DAI and then sell it, right? Because they're going to get a $1 equivalent, but on the outside market, it's going to be worth more than $1. So it's this mechanism of reducing supply so that it can go back up, and then also increasing supply so that the price bumps back down to $1. So that's essentially the redemptions, the borrow rates, and the decrease and increase in supply that's going to help it maintain its $1 peg. Now, next up, we have depegging. So depegging, we already kind of mentioned it. It means that it falls, usually we can say that depegging is falling below $1. And what might actually cause it? The simplest answer, of course, is that the backing fails. So perhaps the company that holds fiat reserves loses them, or maybe they had some kind of campaign through which they made people believe they have these assets when they don't actually have them. And then, of course, people are going to realize it's not worth anything and it's going to crash in price. Now, of course, the backing can also fail in terms of the crypto assets. When there's a flash crash of the crypto assets price, liquidations, the mechanism that keeps the protocol safe, it actually can't even sell that collateral quick enough. And so all of a sudden it's full of bad debt. The mechanism no longer works. And in turn, the stablecoin's price depegs with a significant decrease. It's not just 99 cents, it can depeg all the way to 80 cents, 70 cents. And we'll look at an example where it fell basically to zero. The stablecoin fails completely if the mechanism that's behind it also fails. Now, with synthetic stablecoins, strategy can fail. So USD is just one of the strategies for synthetic stablecoins. But you can, again, imagine since these are correlated with crypto, again, if there's a flash crash, if there's a huge issue on the crypto markets, sort of black swan events, it could lead to a stablecoin depegging because a lot of people are selling the underlying asset that's backing that stablecoin. Market pressure kind of goes hand in hand. Think of it this way. All the stablecoins that are created, minted, they can be sold and bought on external markets. So if there's, for some reason, and that doesn't have to be backing failing or a mechanisms failing, it could actually be certain news about a specific company that backs a stablecoin that leads a lot of people to sell it. And because it's being sold, it's going to start being sold at $1. But then when a lot of people start selling and there's not enough buyers, at one point it's going to have to start selling at 99 cents. And if it keeps going, it's going to fall to 98, 97, 96, so on and so forth. So market pressure is actually going to make it Depeg. And I have a couple of examples to show. One is when USDC actually depegged to 88 cents back in 2023. What happened was that USDC or Circle were holding some of their reserves in the Silicon Valley Bank. And that bank failed. There was a bank run and it was essentially shut down. That news caused a lot of people to actually have huge concerns whether other Circle's backing is also going to fail. And there was a lot of market pressure. A lot of USDC was being sold. And because there was a lot of market pressure, it depegged all the way to 88 cents. And then when news came out and Circle came out and said that all their other reserves are okay, even the assets they were keeping in the Silicon Valley Bank weren't just fiat dollars, it was other assets as well. It also reintroduced more market confidence. People stepped back in, started buying USDC and pushed its price back to $1. Now, an example of a failed stablecoin is UST. Now, this is a stablecoin that was made by Terra Labs, which is now defunct, and they also made a token called Luna. And the way that UST worked was that you have one UST worth $1, and you can redeem it at any moment for the Luna token, for $1 worth of the Luna token. Now, again, this is not collateralized like with BOLD. With BOLD, there was existing ETH backing it. With UST, you minted the Luna. So you would redeem one UST and you would create $1 worth of Luna out of nothing. So one of the key components of this was Anchor protocol, and they had high yield opportunities for UST, 20%. So a lot of people, there's a lot of demand to have UST and to supply it there. And this isn't the only reason, but it was a huge incentive when the yield started falling there. There was a lot of pressure to redeem that UST. And since there was a lot of pressure in redeeming that UST, there was a lot of Luna being minted. So again, a lot more Luna entering the markets. And that also led to people questioning, okay, can this mechanism actually work? Can Luna, the token, sustain this much Luna being minted? And simply put, people kind of gave up on the strategy. They no longer believed in this strategy. They started redeeming UST, selling off UST, and it simply crashed irreversibly. So this was an example of a stablecoin that failed. Why did it fail? Well, one could say that there was no real underlying asset backing it outside of belief in the strategy. With USDC and these other stablecoins, there is something actually backing them. In this case, it was just belief in the Luna token, essentially. And next up, I want to cover yield-bearing stablecoins. Why do I mention these? Just because I want to reiterate that these are not separate stablecoins. These are stablecoins that earn yield, where a regular stablecoin like USDe is supplied, it's staked to a protocol, and then it earns yield. So that's something to keep in mind. For USDe, its yield-bearing stablecoin is called sUSDe. And so there's various other stablecoins you can supply and stake on other protocols and get a yield-bearing stablecoin in return. And that stablecoin represents that underlying asset being used in a strategy, which might be for lending markets, or every protocol has its own strategy, various other mechanisms. The point is it's going to be earning yield, and that one staked stablecoin or yield-bearing stablecoin is going to represent your claim to that underlying asset's yield. Now, to wrap up, I do want to mention for anybody who wants to learn more about stablecoins and all their mechanisms, their backing, how they function, I would recommend checking out Ferris. It has in-depth info about pretty much all the stablecoins. It does risk assessment of them. It has historical depegging scenarios that happened. And it also lets you compare stablecoins between one another. So it's not just simple things like looking at the total amount of that's being supplied. You're also able to view depegging events and a lot more info about that stablecoin. So if you ever encounter a stablecoin you're not maybe familiar with, I would actually recommend checking out Pharos and typing it there. And that's going to wrap it up for the stablecoin video. Again, I didn't want to go too much into detail. The purpose of this was to be an introductory guide into the world of stablecoins and share the mechanisms that actually let them work, not just what's backing them.